You are looking at two bonds. One pays 5% coupon and matures in 3 years. The other pays 8% coupon and matures in 10 years. What makes one different from the other? And why does it matter? The answer lies in the features behind those numbers. Things like how interest is paid, how long until the issuer promised to pay you back in full, and what can happen to the price if you sell early. These features affect how much you could earn, the risk involved, and how flexible your investment is. In this video, we will walk you through the key bond features, explain how returns are generated, and cover what liquidity means if you need to access your money. The information in this video is for informational purposes only and does not constitute investment advice. Always do your own research or consult a financial advisor before making investment decisions. Every bond has 4 features that shape how it behaves: bond issuer, coupon, maturity, and price. The bond issuer refers to who's borrowing the money. A government with a stable economy typically offers lower interests because the risk of a default is minimal. Corporate bonds often pay more because investors demand compensation for credit risk, the chance the company runs into troubles. Coupon is the interest rate the bond pays. Some bonds have fixed coupon, meaning the rate stays the same for the life of the bond. Others are floating and have variable coupons that adjust based on a market reference rate, such as Euribor or inflation. Maturity is the date when the issuer repays the principal. Bonds can be short-term, maturing in a few years, or long-term, maturing in 10, 20, or even 30 years. In general, the longer the time to maturity, the more the price tends to move when interest rates change. This matters if you decide to sell before maturity. So what is the bond price? If market interest rates rise, newly issued bonds start offering higher returns that make your bond, which pays less attractive, and you may have to sell it at a lower price. If market interest rates fall, the opposite happens. Your bond becomes more attractive and you could sell it at a higher price. Remember those two bonds from the start? The 5% bond maturing in 3 years and the 8% bond maturing in 10 years? When you see a higher yield, it's usually the market paying you for taking more time risk, more credit risk, or less liquidity. Let's break down how each one would actually make you money. Bond returns come from 2 sources: coupon payments and price changes. Coupon payments are the interest income. With the 5% bond, you would receive 5% annually until it matures in 3 years. With the 8% bond, you would collect 8% annually for 10 years. Hold either bond to maturity and you get every payment plus principal back. This is a predictable part. Price changes matter most if you want to sell early. And here is where those 2 bonds behave very differently. Now let's say the market starts demanding 2% more yield for bonds like these. When the market demands higher yields, existing bonds with lower coupons become less attractive. To adjust to the new yield level, their price must decrease. The 3-year bond might go from around 5 to 7%. The 10-year might go from 8 to 10%. Both prices fall, but the longer bond falls a lot more because you're stuck with below market payments for many more years. The opposite works too. If rates fall by 2%, both bonds become more valuable, but the 10-year bond would see a bigger price increase because it locks in above market rates for longer. You understand the features, you know how returns work, but what if something changes and you need your money back before the bond matures? That's where liquidity and default risk come in. Liquidity is how easily you can sell your bond before it matures. Government bonds usually have plenty of buyers, so you can sell without much trouble. For corporate bonds, this might be a different story. Depending on the company and the bond's features, you might have to lower your price to sell off your investment. Let's go back to our 2 bonds. The 3-year bond might be easy to sell because it matures soon, so there is less uncertainty about what could happen. The 10-year bond might be harder to sell because they are committing to a longer timeline, especially if market conditions have changed since you bought it. This matters when plans change. Maybe you need cash for an emergency. A liquid bond lets you exit quickly without taking a big hit. An illiquid bond could force you to sell at a discount, even if the issuer is perfectly healthy and making the payments on time. Default risk is the chance the issuer fails to pay you back. Governments rarely default. Companies, it depends on their financial stability. A well-established, profitable company carries low default risk. A startup or struggling business poses higher risk, so they offer higher compensating interest rates. Before you're investing in any bond, 2 questions matter. How easily can I sell if I need to? And how likely is the issuer to actually pay me back? So let's now bring it all together. You know now the 4 features that shape every bond: the issuer, coupon rate, maturity date, and how prices move in the secondary market. You understand how returns actually work, both from the steady coupon payments and from price changes if you sell early. And you know the 2 risks you should consider: liquidity when you need to exit, and default if the issuer can't pay. Going back to those 2 bonds from the start, the 5% bond maturing in 3 years and the 8% bond maturing in 10 years, you can now see why they are so different. One offers lower interest but more stability and easier exit options. The other pays more but locks you in longer and reacts more dramatically to rate changes. Neither is better or worse. They serve different purposes depending on what you're trying to achieve. Before investing in any bond, ask yourself, what's the coupon structure? How long until maturity? How strong is the issuer financially? And if I need to sell before maturity, is there actually a market for it? If you are ready to explore bonds yourself, Mintos offers high-yield corporate bonds from just €50. You can automate with high-yield bond portfolio or select individual bonds and exit early through the secondary market if needed. Which bond feature matters most to you? Drop a comment. If this cleared up how bonds work, hit like. Ready to explore? Check out Mintos. Thanks for watching. Here's to smarter, more confident investing.